Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The media industry has shifted a ton just over the last few years, and one of the companies I'm going to be watching closely is Warner Brothers Discovery. This is a collection of potentially very compelling assets from a content perspective, from a cable network perspective, but it is not a leader in streaming right now, and it's not really clear what the company's financial future is. So I want to dig into a few of the numbers and then discuss a little bit about what Warner Brothers Discovery's strategy might look like in the future. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you're in the Washington, D.C. area, check out the event Money Collaborative that I'm putting on August 18th. I want to start with the release of first quarter results from 2023. This is the high level results. You can see $10.7 billion in revenue. Net loss was a little over $1 billion, and free cash flow was a negative $930 million. Keep that in mind because I think that's going to be really key going through this. This is details from the network segment. And given the fact that this is a couple of companies that were merged within the last year, we have to look at these pro forma numbers right here. That's basically, hey, if we were a combined company, this is what the numbers would have looked like. Distribution down 4%, advertising down 15%, and down 52%. Revenue overall down 12%, and adjusted EBITDA down 11%. Just terrible trends for the network segment. The studio segment was a little bit better, but the trends again are not moving in the right direction. Content, $3 billion in revenue, down 10%, total revenue down 8%, and adjusted EBITDA dropped 25% in the quarter. The one bright spot, if you can call it that, is direct to consumer. Now, this includes HBO Max, which has been renamed Max, and Discovery Plus, but the real driver here is HBO. And we see that revenue was up 2% in the quarter, and adjusted EBITDA was actually positive $50 million. So seems like a sign that the direct-to-consumer business is doing well, but I think this would be significantly better if it wasn't including the costs that go into running the streaming services. Now, the real concern for Warner Brothers Discovery is this right here, $49.5 billion in gross debt, and debt maturities of less than 3 years is 25% of that debt. So over $12 billion worth of debt that matures within 3 years. If you have a business that is burning cash and a lot of debt on the balance sheet, that's just a recipe for disaster. The problem is what changes and what improves for Warner Brothers Discovery. I don't think there's any easy answers to that. There can potentially be cost cuts, but the cable business is not getting better. That's going to hurt revenue directly from cable as well as hurting advertising. The studio business, it's not clear that revenue is going to jump significantly there. And the streaming business continues to burn money. So what is the answer for Warner Brothers Discovery long term? I think the answer ultimately is to get out of the streaming business, get rid of that loss leader, and just focus on content and what you do best. License that content to the streaming company that will pay you the most money. Turn a money-losing business into a money-making business. That is the path to survival. The decline of cable is effectively out of Warner Brothers Discovery's hands, but the future of streaming is still in the company's control. Given the financial direction, I think something else needs to be done. So as we move into earnings season, and we're going to hear more about what competitors like Disney are doing, what Netflix is doing, I think everybody is trying to jockey to put themselves in the right position, but not everybody is going to be a streaming company long term. I think a company like Warner Brothers Discovery is going to be very pragmatic about this, going to start selling more content to other streaming companies, and may ultimately end up shutting down its own streaming service, which is probably okay long term for the company's financials. But what do you think about the future of Warner Brothers Discovery? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. And thanks for watching, everybody. See you here next time.